What's going on, guys? TK Pryor, Master Wealth Builders LLC. Want to welcome you to the strategy session that I talked about. It's the 30th. We have the ability to present you with some simple ideas, and what I wanted to do was to open up with a simple video that talked about Kaizen in terms of how it can help you earn 60% more through OPM.
Retirement. Executives often think investing in stocks and other investments will provide enough income to maintain their current lifestyle for the average 22-year retirement. But in most cases, this ends up not providing the means to maintain their lifestyle throughout retirement. And when they come to this realization, it's too late to do anything about it. Most highly compensated people don't start saving until their 40s, missing out on years of compounding interest. This result is a significant loss in retirement funds, and in their 40s, most are saving only about 9% of their income. So how much should you be saving if you want to maintain your current lifestyle in retirement? 33% of your income. There's got to be another way to meet retirement goals without having to use a third of your income during your career. Well, there is. You now have a way to maintain your lifestyle during retirement. Introducing Kaizen. Kaizen is a proactive strategy that gives you access to extra money up front, providing you the potential to earn more for your retirement, protecting your future income without putting a drain on your current way of living. This strategy helps you maintain your current lifestyle in the event of a chronic illness, premature death, or inability to sufficiently save for retirement. Traditional retirement plans are typically insufficient for high-income earners. Kaizen is different because it makes use of leverage without the need for participant loans, interest payments, or personal guarantees. One of the greatest advantages of leverage is it provides an opportunity to significantly enhance your ability to save for retirement. Experts agree, when used correctly, leverage is a very powerful retirement tool. Even Forbes says you can leverage your way to a richer retirement. Here's how Kaizen uses leverage in a very different way. Your contributions are matched by the lender for the first 5 years. Then, the lender uses that as security for the additional funds for the next 5 years. The contributions are used to fund a cash accumulation life insurance policy. A minimum amount is used to purchase the death benefits, living benefits, while the majority of the cash is used to maximize your potential tax-advantaged growth. What could be better? Kaizen also has unique cash accumulation features within the policy. When a major market index like the S&P has growth, it is calculated and credited to you. Once gains are credited, they cannot decline due to market losses. This helps keep your money safe. Would you rather have this in retirement, or the potential for 60 to 100% more retirement income with Kaizen? Secure your lifestyle with Kaizen. More money, more protection, more confidence. When it comes to retirement,
All right, guys, so that was the brief introduction to Kaizen, which we always talk about, that gives you the opportunity to maximize your growth in a shorter period of time. So definitely get in contact with us or go to our website, masterwealthbuildersllc.com, to find out more information about that. Now I'm going to introduce you to my business partner, and she will get into more details in terms of creating a better life and what we have to offer.
Hello, everyone. My name is Shantae Dennis. We want to welcome everyone online today. We are here in person in McLean, Virginia. We're here to talk about how to enhance your life with using long-term planning strategies for the retirement, but it's a little bit more than that. We're here to make impact in our communities. We want to make sure people are educated on what they need to know. We're in a very volatile market. We are experiencing high levels of inflation. People are currently either in different stages of their lives. They're graduating college, starting a new career, having children, purchasing a home, going into retirement, already in retirement, or planning to transfer that generational wealth. So what we do is we're going to be here once a month, every month in Tysons, Virginia. We're going to have guest speakers. People speak on different topic matters. It could be anywhere from real estate strategies to helping with your retirement, insurance strategies, how to put together a trust, how to protect your family, how to effectively establish your will. We're going to make sure we cover anything that you need to protect you for all of life's uncertainties and things that are happening through transition of every point of life. So I just would like everyone to follow along. I'm just going to start with giving some points and different things of how we can make a better change in our lives today. First and foremost, I represent a company. Our company is called Master Wealth Builders LLC. You just spoke and saw to TK Pryor. He is the mastermind behind the Master Wealth Building concept. I myself have been in financial services for over 23 years. So we are at a stage in our life where we're going through transitions and we want to help and empower others like us to do better as well. Between us, we are representing a much bigger firm. We're here at the office of Dr. Shirley Liu and Associates. She is the founder of Dr. Liu and Associates and best-selling author of IUL ASAP. And now, for the annuity space, she's the author of a new book, which is going to be very impactful and helpful for your life. We also work in real estate, taxes, mortgage loans. We help people in every facet, and we have a team ready to help you develop a plan that will better help you in every area of your financial needs in your life. So the main bottom line of what we are doing here today, we want to teach you the real secrets of money in regards to preparing for life's changes, challenges, or just being ready for anything that you need to do in life. One of the biggest things that people are not ready for, people do not plan to get sick, people don't plan to die, people don't plan, sometimes for the things we know are coming. So we know when we have a child, regardless if they go to school, want to start a business, or they want to get a certified skill, we have to save money to be able to help them do that. Whether it's whatever we decide to do, like I said, business, anything. So what we do is try to educate people and teach people on non-traditional ways of saving to kind of help, be what is the number one thing in America? We pay taxes on everything. Now, we still have to pay Uncle Sam no matter what, but we teach strategies on how and when to pay Uncle Sam and how can it be an advantage for you as well. So we do that by teaching protecting against the market risk. We already know the market goes up and down. When the market's up, it can be very, very good, which is no problem. But we just want to make sure your portfolio is well managed and diversified. So that way, if you do invest in the market, you do have something that's protecting you and still growing and accumulated with principal protection. We also teach about tax deferred growth. So, when you get a 401k for your employer, you will grow that money, but you'll pay the taxes later and kick it down the bucket. But, we're also showing people how to still have an advantage, even if you do have 401ks or 457s or TSP plans. We are here to educate you on how to make that money work better for you. Also, we teach about supplemental retirement. Even though we're here to talk about retirement savings and strategies today, we do have insurance vehicles that also act as savings and provide lifetime income with tax advantages as well, which is something we will talk about in another meeting. But there are so many ways you can use different vehicles to work to your advantage. And the most important thing is providing a legacy to your next generation. So right here, this is where I start. This is most important. Whenever I talk to a new prospective person that I'm trying to help, whether it's a family, a business, or individual. Right now, we're not talking about products. We're not product-based. We're not service-based. We can do whatever we need to do to help an individual, but at the end of the day, it's based upon the person's or family's or business's needs and goals. So at the end of the day, I need to know, what does your future look like? Really dig deep, not just about something you want to do. I want to buy a house. I want to start a business. I want to have children. I want to have this, or so on and so forth. But overall, a lot of people don't think about the big picture. So the goal is you have to know, what is your passion? What are you doing? Where are you going? Even if you're an employee right now and you're working a job and you're not sure of maybe what your future looks like. And if you're solid on what your future looks like, you still can make other plans and adjustments. So we really want to dig deep, want to know what your ultimate plans that you want to achieve. You want to think about what are your dreams and goals. One of the things I talk about when I first sit down with a person, whether it's a client, an individual, or a family, is what is it? At the end of the day, it all starts in your mental. You can say you want to do something, but you have to have the initiative, no procrastination, willing to get up and do every step it takes to do the things that you want to do and achieve in life. So at the end of the day, it starts with you. What do you want to do? I can't motivate somebody to want to take steps to better their lives, to have a retirement plan, or to want to effectively protect their business. Also, another question I ask people at the end of the day, with whatever you do here on this earth, we know money is the driver and it's the tool for things that we need to get done, but how do you want to impact others around you? How do you want to be remembered? What legacy do you want to leave? Not just financially, but how do you want to leave it? So those are important questions when you're doing these things and making these important decisions that impact yourselves, your family, and the next generations to come. So one of the biggest things I like to talk about is quality of life. A lot of us, talk about all the plans and the dreams we have, but at the end of the day, we know as we age, there are different issues that occur, whether we have health issues or whether, people around us are not here anymore. We go through the phases where our parents may pass or we have grandchildren, so on and so forth. So the deal is while you're going through every stage in life, we want to make sure that you're taking care of your health. So taking care of your health can mean just, outside of your employer's healthcare coverage or your self-directed coverage or your Medicare or Medicaid, that you have other things around you to give you support to support your health. We had a real life situation here at our organization where somebody was, battling cancer, and they were able to borrow money from an insurance policy to be able to assist them to pay for other treatments outside the normal way of being treated, all because they started a savings plan through what is called an index universal life insurance policy, and they were able to take from that policy, borrow against it, and take from also the death benefit to be able to supply additional health needs that the health coverage may not cover. So that's just an example. I'm not going to get into insurance coverage today and how that works with living benefits, but it is a key to having sustainability and longevity even in the latter years of your life. The other thing we talk about is the freedom. So the freedom in planning is that if you are protected in every area of life and you have a good substantial savings where you're able to take from or borrow against to be able to do whatever it is that you want to do, it leaves you with a situation where, hey, maybe next year I want to start a business, but I don't know how to do it. But hey, I saved money for 10 years that's growing in a tax advantage account. Let me see how I can leverage that to be able to start my business. And then when you have those type of things in place, say for example, we all work 9 to 5 one time in our life or another. And one of the things we don't leave our job is because we don't have the freedom to say, I have something that can sustain me and I don't have to continue working my job if I don't want to. Now, if you like your job, that's wonderful. Some people are very happy in their careers, it's fulfilling, but a lot of us, have worked jobs, and I can say I'm guilty at one point or another in my life where I worked a job I really didn't want to work, but I did it because I had to. I had to take care and provide for my family. But if you had another way and you can do something you enjoy versus what you have to do, then this will give you the freedom to choose. Think if you start with your baby right now and you started saving from day one. By the time they're 18, they can have a substantial savings account where they can have a choice. Some kids may go to college. Some kids might want to do a trade or technical certification. Some kids might just want to start a business, or they might want to purchase property or get into real estate. So now they had a nest egg from day one where they didn't have the option, like when I was growing up, to say, I don't want to go have a job or I don't want to go to school. I can go straight into preparing to be where I want to work in, whether it's my passion or do something that is more fulfilling. outside of traditional just going to school and going to work every day. Nothing wrong with those things. Those things are wonderful, but it just gives you the freedom to make a different decision. The other thing is also living on purpose. That is a huge thing. You know, a lot of us do things because we were taught to do it, we went to school to do it, but are we really living the purpose that we're intended to be here for? Some people have things that they're very passionate about. People want to help people, they want to start nonprofits or do other things in life. But one of the reasons people don't do what they're passionate about or what their purpose is because they don't have that financial freedom or the quality of life to be able to sustain that. So this is just in a nutshell what quality of life means, meaning living the life that you were intended to live without having to worry about life's uncertainties. Now, some of the advanced strategies that we teach, it won't all be in one session, but we do cover strategies on leveraging. Leveraging could mean just leveraging a savings or anything that you have, whether it's a property or different types, whether it's real estate strategies, retirement strategies, to be able to leverage what you have to be able to, you know, put towards something else. So what we do, or to leverage the savings accounts or different things that you might invest in to be able to have something to borrow against to do something else that you may want to do. So we just teach different leveraging strategies. One of the other strategies we teach is also redirection. Redirection just means is that, you know, you take something from somewhere else and put it to where it's going to work more effectively. So that can, and financially speaking, that can mean you could be taking your 401k and rolling it over into a tax-free retirement account, and you can use that to actually leverage to start and get a business line of credit, you know, whatever you decide to do. Or you can redirect your Starbucks coffee for $5 or $6 or $7 a day and take that $300 a month that you spend on coffee and put that into your savings account, your children's savings account. It's just little things like that, you know, when we teach redirection, things that people don't think about. A lot of time we're overextended with the income that we have. You know, we're going to talk about that in a little bit, about how there's a lot of income disparities in the United States of America, where, you know, we're not earning enough to be able to sustain because of the high rate of inflation. So the average amount of us, we don't have enough income to be able to say, oh, I can't afford to save money because I'm spending, or don't have enough to cover what I already have. But sometimes I just try to let people think, hey, you bought that purse last week. Maybe you might be sacrificing getting a new $1,000 pair of tennis shoes, whatever that may be. Even if that's not you, there's something that we do to the simplest thing. You know, $5 a day does go a long way. So if there's something we had to give up, whether it's going to that McDonald's drive-thru or that Starbucks, that could be something that could be redirected to create something bigger for you and your family. Some of the other things too, you know, we talk about passive income a lot. Passive income is just basically income you don't have to work for. You know, sometimes people just don't know where to put their money at to make exponential or good growth for them. So there's different vehicles where you can take a little but get a good return, and then eventually the money starts making money for you. So it could be a business, it could be a retirement vehicle, it could be some type of other savings vehicles. We do have people within our organization that do specialize in Bitcoin and other types of savings. So maybe we can have a class about that another time. But specifically directed to retirement, we do have people that get residual income monthly from their savings that they accumulated over the years by using these vehicles. Also, one of the biggest things, if you've heard of, it's called infinite banking strategy. So infinite banking strategy is basically you're becoming your own bank. If you're saving into yourself, you have the ability to borrow against yourself and pay it right back to yourself. We go deep into talking about using trust strategies where you can have an insurance policy under each member of the family and it pay back to the trust, and the trust gives instructions to members of the family throughout the generation on how they can utilize or borrow against the trust to be able to pay, whether it's towards a business or other expenses for the family, and pay it back to the family. Now you're becoming your own bank. So there's another deeper level. We can go into that in another class in another day. But the becoming your own bank is pretty much a strategy where, if you've heard of the concept, infinite banking, and we'll get into that another day as well. And the big thing, you know, if you can see my screen, all of these different strategies creates economic independence. So we're not fearful of what the market's going to do. Whether the market crashes tomorrow, whether we have another health scare, whether we go to war, if we are prepared in the right ways, there are vehicles that have been around since hundreds of years ago that have withstood the test of time. Where that even if there was a war and all the banks went under, if you utilize these vehicles correctly, your income or your savings or your wealth will be protected. So that's why it's very important we talk about these things today. All right, so what I'm going to do from right here, I'm going to let my business partner, TK Pryor, take over. He is going to speak on the topic of our wealth disparities and inequality in the United States when it comes to income earning and also retirement. And he'll touch on a few other topics, but we just want to make sure we cover our ground today with making sure people are first educated. So let you know when we're talking to you, we're coming from a place of getting facts and doing actual research when we're presenting to you. So we know how to effectively prepare you and help you for your future. All right, thank you. Further ado, I'm going to introduce Mr. TK Pryor.
Okay, we took the time to put this together. I'm TK Pryor, as I mentioned in the beginning of the video, but the main thing that is very important here, I think most of us don't really understand, or it's not at the top of our mind when we think about where things currently stand according to the U.S. Census Bureau with income in America. You think that your household is okay, but when you look at all of us as a whole, this kind of breaks it down. So the gray area is Europeans, the blue area is the people that's labeled as black, but I don't like using that word. The orange is Hispanic, and this green area here is other, so everyone else, right? So if you look at the numbers, right, share of households, 9%, but share of wealth, we're only looking at 3% for Hispanic, 4.6% for the people labeled black, but 82.4 for the people labeled Europeans, right? And doesn't that kind of put things in perspective? I think a lot of us never think about the actual numbers. So this is just U.S. wealth as a whole, right? If we go to the next slide, this one talks about retirement savings by race. So elderly singles facing economic insecurity. And then it breaks down the economic by ethnicity. Again, Hispanic is at 72. Families that have some type of retirement, 65% European, 44% black. Black people at 64%, Asians at 59%. So this just talks, the top one talks about economic insecurity, the bottom one talks about some type of retirement, right? I mean, if you ask the question to the average person, are you prepared to retire tomorrow? The answer is always going to be no. So this one, income gap by ethnicity in the U.S., Hispanic, Latino, 65,000, European or non-Latino, 80,000, African American, 51,000, Indians, 58, Asian, 106, Native American, Hawaiian, 72, other races, 63, and combination races, 69. So Asians at the top of the chart, but people that are labeled black are at the bottom of the chart at 51,000. So this is from the statistics, right, of the Census Bureau, and we're asking how do we change the narrative. Really, I'm just trying to put that in the forefront. If you understand where you are and where your household stands, you really need to go into some sort of planning. And I think as a whole, what we don't do is plan. Um, Financial freedom means no longer worrying about risk, right? So leveraging that risk with a company on your side to help you in the event something happens. That's what we're talking about. We're talking about you having a hedge against the possibility of not going at it alone. You know, you understand car insurance. You know, if somebody hits your car, you don't have insurance, you have to pay for it yourself. So if you think about life insurance, the concept is not about death, it's about having something to protect you in the event an emergency happens. Because there's other components to insurance. There's the health component, there's the generational wealth, and then there's the ability to build cash value at 6 to 8% without the volatility of the stock market. So let's never leave out those three components: your retirement aspect, your health component aspect, and your legacy, what you're going to leave behind. So I hope the statistics that I brought up really makes you think about what it takes to secure generational wealth. A lot of families don't think about their children and what they're going to leave behind, your legacy. You only think about the money you have now and what fund you can have now. But if you took the time to set up a family trust, if you took the time to set up Kaizen, set up a fixed index annuity, or set up an IUL, put all of that in your trust, now what you're doing is giving your family a leg up. You're giving your children a leg up. So that's what generational wealth means. It means signing some paperwork, putting that paperwork in a safe place, and having your children have a leg up. So this just talks about all of the things you know about. What we try to do is step away from those things and get into what's bundled as life insurance because of the fact that it's off-market products. Off-market just means the stock market is a measure that they use to determine how much gets credited to your account. So you don't have the volatility that comes with the up and down. So if you think about life's risks, right? Untimely death, suffer an injury or illness, or outliving your retirement funds. Especially when you talk about traditional 401k, once you start using it, it depletes. So at 70, you might have to go back to Walmart. The issue that people don't think about when you go from 401k to off-market products that are bundled under insurance, like what I just mentioned, IUL, fixed index annuity, or Kaizen, you don't deplete your account. You build to a certain level. Once you start using it in retirement, it continues to pay you that same amount until you're 120. So contrary to a 401k, which depletes when you start using it and eventually goes to zero, the off-market products that are bundled within insurance, IUL, fixed index annuity, and Kaizen do not deplete. You never run out of money. You can't outlive your retirement because of the fact that it's bundled in insurance. You will get paid the amount that you grew your account to, whatever that amount is. If it's $700 a month, you will continue to get $700 a month until you're 120 years old. So that's the difference. You can't outlive something that's in an off-market product. So outliving retirement funds is something you don't have to worry about. Maintaining your standard of living, providing a legacy, protecting your income for life. So that's the big difference. When you talk about why would I go out of my 401k and switch over to off-market products? Well, here, this is it. Income for life and protecting your wealth. It's insuring your money. Understand that concept. We want to teach you how to insure your money. That's what rich people have always done, and that's why they stay ahead of everyone else. So life's risks, you're protecting. You're basically giving yourself a hedge against life's risk because you're partnering with an insurance company that says, if an emergency happens, we're here for you. Don't worry about being alone. You have us. So all of the all without the traditional risk of, so what this is basically saying is you don't have to worry about losing your money. There's a part that's called principal protection. This is talking about principal protection. You will never have to worry about your account going into the red. You never have to worry about losing a dime of the principal that you put into any off-market insurance product. An FIA, an IUL, Kaizen, whatever you put into the contract, you'll never lose a dime of your principal. So that's what this is talking about. So tax advantages, I'm going to turn it back over to my partner because she is the expert on this, and I'll be back at you.
All right, everybody, I'm back. So he's right. I am also a licensed tax accountant, so I can't speak freely and give you some real tips on tax strategy. So the biggest thing everybody knows, unless you're in certain states in the United States of America, you have to pay taxes upon contribution and pay taxes. You have to pay taxes at some point, whether you're putting money in your savings, or while you're growing your savings, or while you're taking it out. Now, the key to this is choosing which way, or strategize to which way you want to do that. Now, most people don't consider that when they're saving money in the years they're contributing, depending on what's happening in our economy, that you could be in a lower tax environment. People that came out of the 70s and 80s were taxed at a higher rate. Currently, we are technically in one of the lower rate tax rates, historically speaking. But we do know one thing, taxes will eventually go back up. So what we weren't educated on is while we were saving, whether it was in a 401, excuse me, whether it was in a 401k plan, whether we were saving in a bank account, in a CD, stocks, bonds, whatever, is that as we age, there's different tax environments. It's knowing when you contribute, well, if the tax rates are lower at that time, maybe that might be the time to say, hey, maybe I want to pay the taxes now so that when I take out later, I'll have the majority of my money. So people may not, wow, I didn't know that. I didn't know I could structure or move my money in a tax advantage way where it can be withdrawn without having to pay the higher tax rate. So those are the things that we'll talk about. So you have to pick one of the three. You can't not pay Uncle Sam. You have to pay the IRS at some point. But when you pay, you can just be smarter in the way you do it to make it work for you. So the preferred way to do it, or the more advantaged way to do it, would be to do it upon, you can only get two of the three. So the best way would be maybe to contribute during contribution to pay the taxes, or during the accumulation. But you can also, in the retirement vehicles that we are going to talk about and speak about today, you are able to get a deferred accumulation and a tax-free distribution. So I know you're probably asking me, how is that possible? Because I know usually when you withdraw from a tax account, a savings account, especially your retirement or a tax-coded account, you will have to pay the taxes when it comes back out. So what we use to be able to guarantee this is something called the power of indexing strategy. So indexing strategy is accumulation of growth with guaranteed principal protection. So meaning you can't grow with the market. Now, it may not be at the highest rate the market is offering. It's a crediting strategy towards the market trade line, like if you had an S&P 500, BlackRock, Bank of America trade line, whatever that trade line you're contributing to. But if the market does go down, whether it was a COVID, the 2008 real estate crisis, or 9/11, your money would be protected. You wouldn't lose anything in your principal balance. The good thing is that you will grow tax deferred, and like I said, you'll be protected from any market downturns. Now, the benefits of indexing strategy, there's a lot of them. I'm not going to go over each and every one of them today, but the main thing is with indexing, you can create, and the reason I'm saying indexing, because indexing can be used in terminology with indexing universal life insurance, indexing fixed annuities, which is what we're going to discuss primarily today. A lot of people are familiar or maybe a little bit familiar with the word annuity, but people don't realize there's so much diversification in the annuity market. It's not like the old school fixed annuity. You know, you just get a rate and you grow it, may go up, may go down. That's not how it works. So with the indexing strategies we use, we call it the Swiss Army knife of insurance, meaning it can do multiple things for you. So indexing strategy and retirement with maybe a combination insurance strategy can provide you 2 tax-free incomes and pensions. You can actually create as many of them as you would like. You're not bound in this world to just having one retirement strategy as traditionally taught. It can also give you a double payment if you get sick. So remember we talked about quality of life earlier. You know, you might need to have some type of reserves or money if you get ill or you can't do some of the things that you would usually do in your everyday life. So these type of indexing strategies do provide a medical component where you can get paid more if you're experiencing a medical difficulty. Also, we talked about this earlier, the becoming your own bank. You can borrow from your own savings and pay it back to yourself. And you can still utilize the money and have it for you when you're ready later. Also, this type of retirement strategy allows you to pass it on to the next generation. So I'm not sure if most people are familiar, but not necessarily all previous 401ks or 457s could be transferred as a benefit to whoever you designate, whether it's a spouse or a child as a beneficiary, depending on how it's set up. And then the fifth thing that it you can do with it, and I touched on it a little bit earlier, you can use these different types of fixed index annuity strategies as leverage. So if you go to the bank and you say, hey, I want to open up a business, what are going to ask you first? Well, what are the assets you have? Do you have assets? Do you have anything that you can use as collateral? Well, these type of annuities, if they have cash value, can be used as collateral against a lending tool or a loan. So those are things that people don't always think about. And the key thing I always say, your money should always be working for you. Now, this is an example of what an indexing strategy looks like. This was an actual client back in, I like to show this one because this was 2020, the year that the pandemic hit. So this was the last time there was a big market crash. So this particular client put a little bit under, they put about a little under $200,000 into their annuity right before the pandemic hit. So as you can see, what's represented in the orange line, this is actually what the market did. So that represents if you had your money in a stock, a mutual fund, a 401k, 457, 403b, TSB, whatever it is. That's what your money does in the market. It goes up and down. So this particular person, they had a little spike. The market was going good at the beginning of 2020. So they earned some money. Then it took a little downhill trend. So they lost some money in what they earned. But then the market did very, very well. It shot all the way up. Now we know what happened when everything shut down. The economy took a turn down. So we have one of our serious losses of the decade for most people that had their money in the market. And this particular person, they were at 262,000 here, and he went all the way down to 210. So they lost about $50,000 in their retirement just in that particular loss. Now the blue line represents indexing, whether that money was in an indexing annuity or it was in a universal life insurance policy. So their $200 got up to $250,000, but what happened is when the market went down a little bit at that moment, it locked up. So they took no losses. So it remained at $250,000, while this one took losses and went down almost back to the original $200,000 they started with. Now, when the market took that upward trend, they earned an additional $18,527,000. So it went up. Now, if you notice, they didn't earn as much as this person did when it went up, but they retained what they kept in the first loss, and they also went up. But when the big market crash happened, they took 0 losses. And basically what it does is flatlines until the market takes an upward trend again. So at the end of the day, they made out better than the person that had only 210,000 in the account. Even though they went up high, they retained what they earned there. So that's just to give you just a real visual and thinking. I know there's people out there that like to do stocks, play on the market, like the highs and the lows, which I used to do that as well too. But I just tell people, you want to still have things that are safer and then still have things with your market growth where you can retain and not take as much loss. So it's just about the balancing out. If I have something on the stock market, let me make sure I have just as much in something that's growing safely. Or if you totally want to be safe, you can move all of it off the market and move it to a safe place. But it's whatever you choose to do. I'm just trying to give you ideas to think about, especially with the volatility of what's happening in our nation and the things that have happened in the last 3 decades. So in the last 3 decades, we had 9/11, we had the real estate crisis, and in the 2020 year, we had COVID. So we know something happens almost within a 10-year time span. So anything can happen at any given moment. We just want to make sure that you have something that is protected. So the bottom line is we want you to enjoy the gains, but without all the risks. Now, if you want to still play the market and have your fun, you can do that, but just make sure you're balancing. Talk to your professional. It could be me, it could be somebody else. But the goal is to make sure that you're having these conversations with the person that's managing your accounts, whether you come to First Financial Security, work with us here at Master Wealth Builders. We want to make sure that you're just having the conversation to review your portfolio. I've had clients recently retire and they didn't even know what they had to be able to retire or if they even had enough. So we want to make sure you're not in the position where you've taken so many ups and downs in the last 3 to 4 to 5 decades that you're not where you need to be in your earning goals. And that's what we do here as well. So this chart is just pretty much showing, traditionally, what we have done over the last 4 to 5 decades. So we know when it comes to the insurance side of things, we had traditionally, when you get a job, you get group and whole term and individual term, which only you keep it when you're with the job. So the purpose of that group and individual term is just if anything happens to you while you're employed, you have something to cover you, but usually it's very low. It may be like $50,000, maybe not enough. It could be high, but if you try to convert it, the rates are very, very high upon conversion. So I'm always educating and telling people, make sure you have a form of permanent insurance along with that employer insurance that will cover you no matter whether you stay with the job, become self-employed, or God forbid you get sick or anything happens, that you would still have something to take advantage of, and then you got it while you were healthy. Also, whole life is still a good policy. The only difference between whole life and the permanent insurance that's on this side, that index universal life that I spoke of, is that it doesn't provide those medical benefits that I'll talk to you about. There are accelerated benefits that come directly out the death benefit, so that if you are chronically, critically, or terminally ill, we even have some policies that'll pay critical injury. We have a company right now that actually gives money, or it gets accelerated benefit for Alzheimer's. So those are things that affect, all of our families, everyday life. We've had family members have illnesses, whether it's while they're young or old. You just want to have something available to you when things happen. The other 2 vehicles that were traditional, they did have what was called a variable universal life. So that was the one that goes up and down in the market. So it's not high risk, but it still had a level of risk. But now they've created the index universal life, where you pretty much have no losses. You accumulate over time, and it does have that cash value accumulation, just like the retirement annuity does. And it does allow you to receive some type of income, benefit for a lifetime or up to 120 years, which was not the usual with whole life or any other type of insurance policy. With term life, it is what it is. It has no health value, it has no accumulation value, and it ends at a certain time. So if you're still in a term policy, you might want to rethink, having a conversation to look at your permanent insurance options. But that's on the insurance side. So today, we're talking about planning in the retirement space. So traditional retirement, those are those tax coded vehicles I talked about earlier, the 401k, 403b, 403c, 457 TSP. Now, you are in those particular vehicles, usually you're paying some type of management fee for whoever is managing those funds, whether it's your Edward Jones, Charles Schwab, so on and so forth. All those vehicles have potential for loss and gains. Um, IRAs and Roth IRAs. Now, I worked in banking for several years. IRAs are still a good vehicle, but you need to be educated. There's IRAs that are tax coded to be that where you have to pay taxes in those IRAs, or maybe they don't accumulate as well. You need to know the difference between simple and compounded interest. So those are important terms to know how you're accumulating. The Roth IRA is still a good idea. Most of the annuities that we have here are still IRAs. So it's just knowing the difference of how each IRA and how each annuity works. Roth IRAs are also convertible, so you could do a partial rollover or a full rollover. It just depends on the rules of your IRA. So there's ways to even make your Roth even better than what it is now. And then, of course, we talked about stock options, putting your money directly on the market. And then money markets hardly exist anymore, even in banking. But that was another very safe way, or a very minimum way to earn interest on your money. So now what I want to introduce everybody has not heard of the index annuity. Now, I talk to a lot of people, especially 55 and older Americans. They all know what traditional annuities are, or at least most do. But the index annuity is a vehicle that's different from traditional annuities. These annuities are not what they used to be. These annuities are designed to transfer generational wealth and give you a lifetime protection where the money never runs out. So the majority of our index annuities, they do have bonuses upon rollover. It depends on how you want to earn your money and how you strategize. So we always leave it to you to decide how you want to design your vehicle, because remember, at the end of the day, it's all based on your goals and your needs of how you want to earn and how much you need to live comfortable or a good quality of life. One of the biggest questions I ask when I'm consulting with the client is, how much do you need a month to be good, to be okay, and to live a good quality life? For some people, it can be very modest. Some people want to have a simplistic life. Maybe they just want to do business with their with a self-employment hobby. Maybe they want to help with their ministry. Maybe they want to just be there, or just live a simple life, not do much. But then I get people, I want to travel the world. I want to buy properties and real estate. I need to have $100,000 or $200,000 a year coming to me in my retirement. And most people would think that's unheard of. But if you use this vehicle the right way and redirect your money into the right places, it is very possible that you can have that quality retirement or that quality of life that you dreamed of. So some of these vehicles, let's say you had a $100,000 401k or TSP, and you wanted to roll it over to start accumulating wealth, you would get an immediate 5 to 10% bonus on what you just rolled over. So that means if it was a 10% bonus and you used a specific vehicle, you would have $10,000 right away, earn interest that you didn't even have to work for, along with your accumulation value, whatever that may be at that time. Right now we have rates around 6.5% fixed. And then we have clients that choose the options where they can still play the market. They don't have to do a fixed rate. They can do a combination strategy of fixed and using a market S&P or a BlackRock or whatever they choose to use to accumulate value and still earn at a higher rate. We also have the vehicles that do offer that you can take out 10% per year with no penalty or early withdrawal fee, which is kind of unheard of. So, in traditional annuities, if you had a 5-year, 7-year, or 10-year annuity, you could not take out that money until the term was over or by the guidelines that annuity specified. So these annuities have a lot of flexibility. We know people get tempted to take out of their retirement. I have them every year at tax season where somebody withdraws for their 401k because they had an emergency. Now, the goal of these long-term vehicles is not to have to take from these, but if an emergency occurred, this vehicle will give you the ability to be able to take out up to 10% each year if needed, only if needed, to be able to utilize while you're still living. Now, we do have another strategy for that where we sometimes encourage customers to do a double investment strategy where you can roll over your 401k, say if it was $500,000. But I had a client recently do this where they took out $50,000 to set up their own insurance policies, to contribute towards their business, and a few other things that they desire to do. So you could do something where you can take the money and reinvest it in something else. But because they got the 10% bonus, that 50,000 came right back to them. So that's another strategy as well. Another strategy people do is that they take out the 10% every year to fund the insurance policy or the indexing IUL, which is an investment vehicle. So they cash front load that vehicle so that it does pay them out income during their latter years. So there's so many strategies where and that's another form of free direction, taking something that you already earn and putting it to pay something else, not coming out of your own pocket. Now, in the beginning of this workshop, I know Mr. Pryor played a video for you guys in regards to Kaizen. So Kaizen is what we call the 5-year retirement plan. So just to be very simplistic, if you want to learn more about it, definitely give us a call for consultation. But the bottom line is that as long as you're age 18, you can start participating in this plan right away. So it doesn't matter when you start, whether you're starting young or starting older. If you were 55 and you missed the bar to be able to contribute to your retirement, well, this is a tool that allows you to aggressively catch back up. It's not traditional. You're not bound by tax guidelines where you can only do a maximum contribution every year. So with Kaizen, it's a hybrid of an insurance and a bank retirement vehicle. So you're able to, say you put in, it's a high contribution though, it's very aggressive for 5 years. So you have to have at least a minimum 100,000 household income to even be able to participate. But say your participation is 24,000 a month, it depends on your age. So for a young person, a contribution to Kaizen might only be $18,000 or $19,000 a year. But the good news is, after that 5th year, you don't have to contribute anymore, and your child's or your college student's retirement is paid for the rest of their life by the time they end college. So we actually had somebody here that paid for their sons and their daughters' Kaizen, and by the time they graduated college, their whole retirement was already paid for them. And they have multiple years to keep accumulating interest, tax-free, tax-deferred, and it's accumulating and indexing compounding interest strategy. So that's another thing to do. If you're an older person, 50 years and over, and you haven't started your retirement, or maybe you're one of those people that kept pulling out your retirement and you don't have enough, well, this might be the time to play catch up. You can take money from a source, whether it's redirecting it from your 401k, and just whatever you have to do, aggressively contribute year to year, and the lender actually matches $3 to every $1 you contribute for the purposes of growth. So the way it works is that you and the lender contribute for 5 years, and they contribute your contribution and their contribution for the end of the 5 years. So it works out very great. But we're going to have a whole class and structure just to talk about Kaizen, because there's so much to talk about around that. So I definitely would say reach out to us if you want to learn more about how Kaizen works. It's just an additional strategy. I've had clients that do Kaizen on top of their 401ks or annuities or other plans, or maybe in combination strategy, or you can just do Kaizen by itself. But it depends on what your strategy is and what you want to do. But it gives all the benefits of what those indexing annuities give. It gives you a tax-free death benefit, it gives you tax-free living benefits, and guess what happens? Your family or your beneficiaries get that generational wealth passed on to them. So that's the key thing. It's not only is your retirement helping you during your retirement or paying you while you're still here, it's also going to pass on to generations to come, or whoever that beneficiary may be. And it also gives you a tax-free retirement income. And if you do have an employer that takes on the Kaizen plan, like your employer can actually implement it in your office if they chose to, and they can choose to contribute on behalf of you or not. So it gives you the option to be in control. So if you go from job to job, contract to contract, business to business, you can continue to have a retirement plan that you don't have to worry about moving from company to company. All right. So I'm going to take a break here. We have so many things that we can give you information on. We just want to make sure you're getting the education to make decisions. There's so many things. We have military retirement plans. I can go on and on for a long period of time, but we want to spoon feed you. We want you to come out to our next session so we can give you further details and information. Um, but I will go over this real quick before I do decide to break on this. But we do deal with a lot of military, especially in the area that we're in. If you have service members, active, non-active, veterans, already retired, we do help with people that are already in receiving VA retirement plans or disability. We do still have the ability to roll over or help people reinvest their TSBs, maybe redirect the funds they're getting already to make it grow better, because we do know sometimes they're not even getting enough money to be able to move forward once they leave the military or retire. So we do have avenues and to the help, regardless if you were part of the pension, VA. We know about legacy, blended retirement plans. So, just let us know how we can assist you, but we would definitely want to give you more information on this as well. All right. And one last thing, I do want to go over this real quick, even though I'm going to do this in another session or really touch bases on this. I just really want to dig deeper and go more into the annuities. But, the IRAs, I'm going to make sure people are very educated. There's different types of IRAs, SIPA and SEP IRAs. This was part of the Secure 2.0 Act, where they're giving different types of contribution credits or contributions that are going to be maximized, or you can contribute more. So, you can look at the screen. It's just teaching you in regards to how you can contribute in going forward and how the employers can make a difference in the contributions to these Roth accounts based on the new Secure 2.0 Act. I do have a whole class just geared towards the Secure 2.0 Act. We will be putting it out soon on our YouTube channel, so you can check that out. But I don't want to overwhelm you with too much information in regards to this. But it's very important because these are the vehicles that we can utilize to redirect for the annuities that we're talking about today. And at the end of the day, it's, even though we're the educators, we're the financial wealth strategists, we are the financial professionals, it's your plan, it's your family, it's your life. So whatever you need to do or to plan for, we're here as professionals to give you the tools, the guidance to be able to assist you to set it up. But at the end of the day, you continue to make changes. Once you make a plan, you can always change it, you can edit it, you can add to it, you can take from it. It's just up to you where you start. So we're encouraging people, don't wait till tomorrow, to do whatever you need to do today. I actually had a client right before coming here. I was supposed to be helping him and having an appointment next week in regards to some of the things he wants to do and make adjustments to. He actually just had a stroke. He was supposed to meet with me next week, and this is not the first time I've had this happen. I had a guy that was supposed to set up an insurance policy the very next Monday, and he went and had a stroke. He was a business owner. So you don't want to be in these situations, where you wait to the last minute. We want you to make a move. We want you to at least have a conversation. We don't want you to procrastinate. And I'm going to put it out very urgently. I'm not going to be very nice, because just like what happened with that client, he was going to meet with me next week, but we've been talking for months. And he was finally going to come to the table next week. He knows he has an issue. He was helping health issues and declining health, but he never probably thought this was going to happen. He has tubes in his body, and his wife says she don't know if he's going to make it. And they don't have a will, they don't have a trust, they don't have insurance policies. His wife is waiting for her green card and is completely dependent with his 2 children. And if he leaves this earth today, they don't have any generational wealth being passed on. They don't have a house in their name. They'll be homeless. It's so serious to be able to, be able to plan, to not wait on things, to do things as soon as you can. Don't procrastinate. We're not even salespeople. I don't care. It's not. I wouldn't say I can care less. I care a whole lot. I'm very passionate about helping people. But at the end of the day, it's your choice to pick up the phone. It's your choice to take initiative. That's why I say I'm not even talking about having an official appointment. That's just have a conversation. What is it that you're needing? What is your business, your family, or yourself needs? Then we can set up the official conversations. Then we can take the steps to say, okay, let's start a plan. So all I want to do is be able to extend ourselves to you. We're part of First Financial Security Incorporated. We're here at Dr. Shirley Liu and Associates office, and we are Master Wealth Builders LLC. That is our brand, because we want to continue to educate you on the things that you can do. And I'm going to have TK Pryor give his last remarks, or he said he'll give his remarks the next time or the next appointment. So we're going to put out the next date next month when we'll be coming back here. When we come back here, you'll get to see what we really do. We do support our local business owners. They come up and speak. We do raffles. We do networking. We do a lot of things. We bring other speakers will be here next time that will speak on other subject matters that may be important to you. But the goal is just check us out, or you can email us at admin@masterwealthbuildersllc.com. We will post everything on our website where you can reach us and how you can contact us and at least set up an appointment to have a conversation today. Thank you very much for everybody online and everybody that came out today. Have a blessed and wonderful rest of your evening.